Yes. So, yeah. Hi, everyone. Good evening. Uh, so, welcome to the new session of Jargon Buster Webinar Series. So, in the last session, we actually discussed about term sheets. So, this session is actually an extension for the previous session. We'll be discussing few things which we actually discussed in the previous session also, because there are a few overlapping things which maybe like if I could not explain in detail, or I could not take more questions. So those things also we'll be addressing in this session. So yeah, so this again, understanding term sheets part 2. So let's jump straight into like a quick recap of what we discussed in the last session. So in the last session, we actually discussed like what a term sheet is. So you guys know that a term sheet is a non-binding document. It's a blueprint for the uh, next set of funding, like how your fundraising is going to be, what are the key clauses that is going to be in the shareholders agreement, and like how the valuation is going to be, how the ownership percentage is going to be, how the controls is going to be. All those things would be mentioned in a term sheet. Then why term sheets matter in fundraising? Because that's the blueprint. That is where you need to do the negotiation and everything, and you come to know like what all rights the investors have, what all rights you have. All those things would be mentioned there. Then when term sheets are used, like I've told, it's typically like once an investor sees potential traction in your business and they want to invest in your business, but subject to like due diligence or something else, or like they want more validation or something, they issue a term sheet. Then like after the term sheet, they do a due diligence, they negotiate on other terms, then go for a final agreement. So a term sheet is not an end of the fundraising journey. It can be treated as an official start of your fundraising journey, because that is where you actually have a relevant document or some sort of like documented evidence as to like you have got a soft commitment or like a commitment from an investor. Okay. Then the pricing terms, what is pre-money, what is post-money, how these things are mentioned in the term sheet. This we discussed. Then economic rights of investors. So what are rights does an investor have with respect to the fundraising round? Then the overview of important clauses. Okay. So in today's session, we'll be diving deeper into few clauses, which actually we discussed in the last session also. So the clauses we are going to discuss, or like the topics we are going to cover today is, first is again liquidation preference, then anti-dilution protection, pro-rata rights, founder vesting, board rights and control, tag along and drag along rights. Practical, I'll show you a practical term sheet example. I mean, it's not an extensive example, a small one, like like a couple of clauses. Then a founder checklist before signing, like what all things as a founder you need to check in the term sheet before you sign off the term sheet. Okay, so primarily, like why these clauses matter, why the clauses which I have mentioned matter is like the first thing I want to tell you. So when founders receive a term sheet, most attention goes to valuation. However, the real economics depend on the clauses. So if you whenever I speak with any founder also, typically the question revolves around valuation. The founders typically have doubt around like valuation. What value should I ask? What is the valuation that I should be asking? Is this a good valuation for my company? This investor has come up with this valuation. Shall I take it? So these are the questions which, as a consultant, I get from most of the founders. And from my experience, I've felt that founders are also more like aligned towards the valuation thing, like I should close a better valuation. And in that case, they've like forget to negotiate on the remaining clauses, or they are not much aware, or like they are not much serious about what other clauses they are going to commit. So that's why like we need to be aware of these clauses, like what are you signing off, what are you committing to an investor. Those things you need to be aware. So primarily it's economics, who ultimately makes money and how much. So that is there, like who one thing, like if you are fixed on a valuation, what percentage the investor is going to hold, what percentage you are going to hold, and at the time of exit, what percentage you are going to get, what percentage the investor is going to get. So whoever have attended the last session would understand what I'm telling about liquidation preference. I'll take that again, like in the coming slide. Then control will be there. Who has decision-making authority? For example, you get a good valuation. You negotiated 400 crore and you got a valuation, but the investor takes the board seat. They're telling that, okay, from your side, you can keep one person as board of director. From our side, there will be 3 people, which means that the company is going to be run by the investors. So you won't be having any control. So like who has decision making? So control is decided in the term sheet. So you need to be aware of what controls you are giving to the investors. Then the protection from an investor side, how investors protect their capital. Because see, the term sheet is not, be it term sheet or any agreement, it never can be like a unilateral or one-sided. It always should be like bilateral and two-sided kind of thing. It should be protecting the interest of everyone. So just like how I've told about the economics and control example, the investor also needs protection for the money that they have put into the company. So how the investor is protected with the kind of capital that they have deployed in your company. So that comes in the term sheet. Then the exit outcomes, like how the money is distributed at the time of an exit. So when I say exit, it can be a liquidation, it can be an acquisition, or it can be an IPO. So it can be any of the 3. So at that time, like how the money is distributed, who gets what percentage, who gets what amount of money, all those things are there. Clauses can impact outcomes more than valuation. So that's one point I have noted there, if you can see. See, like valuation is just one element of a fundraising thing. Obviously, you should negotiate on valuation, you should get good valuation, or you should get reasonable valuation, I would say. So along with that, you should be aware of the kind of clauses also that you are committing. So clauses can impact outcomes more than valuation. Okay, so valuation is not just one thing which impact the outcome of a business or the eventual flow of the business. Clauses are more critical than valuation, which eventually is going to create the flow of the business. Okay, now we'll come to liquidation preference. So I've told this in the last session also. So liquidation preference means like who gets paid first in case of an exit. Okay. So like I've told this one. So exit events can be acquisition of the company, merger or sale of majority stake, liquidation or closure, IPO. So I've mentioned 4 scenarios here, like contrary to what I told in the previous slide. I told 3. So there can also be a merger or like sale of majority stake that can also happen. So liquidation preference actually like mandates who gets paid first and what amount or like at what rate does they get paid. Okay. So again, like we will discuss about the common structures in liquidation preference. So first is 1x non-participating. Then we have participating preference, then multiple preference. Okay, so I'll tell you. Okay, let's consider an example of wherein the investor has put in a money of 5 crore rupees into your company, and you spend 2 crore for product development and marketing, and eventually you realize that this business is not going to work, and now you want to wind down the company, and the investor invested 5 crore at 10% dilution. Which means that the valuation was 50 crore. So the investor owns 10%, you own 19%. But now you're winding down the company and you have 3 crore money in the bank. Now if you wind down the company as it is and there is no liquidation preference or anything, this 3 crore should be divided amongst the founders and the investors in the shareholding ratio, which means that as a founder, you would be getting 90%, the investor would only be getting 10%. So you'll be getting 2.7 crore. And the investor would be getting only 30 lakh of the 5 crore which he has invested. So you were not able to run a business properly, so you had to wind down the business. Still, you are making 2.7 crore of the 5 crore which the investor has invested. And the investor, even despite having 3 crore money in the bank, they are going to get only 30 lakh. So that doesn't sound fair, right? So that is where actually liquidation preference come into play. So typically, like what investors do is that they have a liquidation preference. So they should be settled in priority before the shareholders are settled. So if there is a liquidation preference clause agreed upon in the term sheet or like in the shareholders agreement, what happens is that only after you repaying back the 5 crore to the investor, you will be settled. So in the example which I told right now, you have 3 crore in your hand. Okay, so 3 crore is the amount you have in the bank. When you're winding up, you need to pay 5 crore to the investor first, but you have only 3 crore. So you pay the entire 3 crore to the investor, wind out the company. For the remaining 2 crore, the investor cannot like kind of approach you. Typically, if it is not a debt or anything, that 2 crore they will be writing off in their books. But this 3 crore you have to give back to the investors. So that is where liquidation preference come into play. So liquidation preference means the investor gets the preference over other common shareholders or the founders in case of an exit. Okay. Now let us look at the common structures also there. First, I have told 1x non-participating. So when I say 1x non-participating, it means that the investor just gets the capital what they have invested in the company. So even if you get a successful exit, the investor invests 5 crore rupees. Okay. And say eventually you're winding up the company and you have say 8 crore in the bank. It means that the investor would be getting only 5 crore what they have invested. So they are non-participating. So the remaining 3 crore will come to you. Then we have participating preference. That is where typically like kind of, okay, that is capital return plus pro rata share of remainder. Which means that if you exit for 8 crore, the investor gets 5 crore first, what they have invested. The remaining 3 crore would be divided in your shareholding ratio. Which means from the 3 crore, you would be getting 2.7 crore and the investor would be getting 30 lakhs. So eventually the investor gets 5.3 crore and you will be getting 2.7 crore. Okay. And then we have multiple preference, 2x, 3x. So this is, this is a bit abnormal scenario. This is where you actually will have to negotiate. I haven't seen too much of term sheets or engagements or a shareholders agreement where investors write more than 1x. So in this scenario, what happens is now if you exit the company at for say 10 crore, the investor invested 5 crore and you are exiting the company at 10 crore and the investor has a multiple preference of 2x, which means that you will have to repay the investor 10 crore. Only after that, the balance amount you can take and distribute in the shareholding ratio. Okay. So that's why I've been telling like typically like kind of multiple preference, I haven't seen in much cases, but in few cases the investor may negotiate that. In few cases the founders will not be going through these clauses. So you might have already committed to like kind of 2x or 3x. That can also happen. Typically like kind of where multiple preference would be coming is when investor invests at a very critical stage of your business, like you currently don't have any runway and they are doing a bridge round. For that bridge round, maybe like they'll put in a 2x liquidation preference because they are betting at a very like kind of critical stage of the company. So there can be instances like that, but in a normal deal, I haven't seen multiple preference in much of the cases. So typically it is 1x participating, which I've seen. But there are these structures also existing. So be clear about like what you're committing to the investor in case of a liquidation preference. This clause protects investors if the company exits at lower valuation. You understand this, no? So if the company exits at a lower valuation, the investor has the right to get their capital first so that they are secured. Okay. The liquidation preference example. So investment is 5 crore, investor ownership is 25%, and the exit value is say 20 crore. Okay. Which means that I'm putting 1x non-participating. Investor chooses the better of return of capital or 25% of exit. In this case, like both is coming as same amount, 25% of 20 crore and return of capital both is 5 crore. So the investor would be receiving 5 crore. In case of participating preference, the investor receives both. So return of capital and 25% of remaining, which means that firstly the investor gets paid 5 crore, then the remaining 15 crore, the investor is owning 25% in the company, so they get 25% of 15 crore, which is 3.75 crore. In that case, investor would be getting 8.75 crore in total. Significantly reduces founder returns. See, even though it significantly reduces founder returns, I think that is a fair way to go about it, is what I believe. Okay. So now you have clarity on what is non-participating and what is participating. Now we'll go to anti-dilution protection. Like the name suggests, it actually protects the investor if the company raises fund at a lower valuation. Okay. So a company raising fund at a lower valuation is typically called a down round. So the common terminology we use in fundraising language is down round. So how it works, adjust the investor's share price or conversion ratio to compensate for the value decline. Purpose, protect investor value from being eroded by future down rounds. Okay, so I'll just explain that with an example. For example, in the Series A, the investor invested in the company. At that time, the share price was 100 rupees per share. I'm not telling the overall valuation of the company per share price. But for some reason, you have to go for a down round. The market scenario is not that good. And in Series B, you are raising at 60 per share, which means that an investor investing in Series B, like for example, an investor investing 10 crore in Series B, would get more number of shares and would get more percentage of stake in the company than an investor who has invested 10 crore in the Series A, which actually is not a good thing. See, it's typically like enough who has bet on the company earlier should get the advantage of that. Okay, so typically the graph of the company's valuation should go upwards. That is the expectation what every investor have and every founder have. But for some reason, when you're raising the down round, the investor need protection to like kind of make adjustment to the investment amount what they have done. Without protection, investor shares are now worth 40% less. With protection, share price or conversion ratio is adjusted to offset the dilution. Okay, so I'll like kind of give you an example also. I mean, the types of anti-dilution cases also. I mean, see, typically like it's nothing but the investor. See, in each fundraising round, the investor also has a dilution. Everybody has a dilution. So currently, if you are owning 100% of the company, when you raise like kind of fund after diluting 10%, which means that you become 90%, the investor becomes 10%. In the next round, if you are again diluting 10%, that means that your 90% would become 81%. So 10% of 90% you will dilute, you will become 81%. The previous in first round investor, 10% will become 9%. He'll dilute 10% of 10%, which is 1%. He'll become 9%. And the new investor will get 10%. So this dilution typically would be happening in every fundraising round. Okay. But when there is a down round, automatically the investor's value gets like kind of reduced. So to protect that, they come up with this anti-dilution thing. And there are two types of anti-dilution. One is full ratio and the second one is weighted average. So like I've told in the previous session, full ratio means investor price resets completely to the new lower price. So if the initial price was 100 rupees and the new round price is 60 rupees, shares adjusted to rupees 60 level. So I'll give you an example. So if the investor typically like kind of invested say 60 lakh rupees into your company. So the number of shares that the investor would have got at that point of time would be 60 lakhs divided by 100, which is going to be what? 60,000. Okay. But in the current scenario, the share price is 60 rupees. So now, if the investor had invested in this round, they would have got 10,000 shares, but they got only 6,000 shares. And number of shares is actually like kind of directly linked to the percentage of holding that you have in the company. So which means that the newer investor got much more this one. So to protect the investor who has come in at an early stage, their previous share price also get adjusted to 60 rupees. And eventually they also get 10,000 shares. Okay. So that is how anti-dilution works in the case of full ratio. In case of weighted average, adjustment considers both price and volume of new shares. Okay. For example, in the previous round, you were an investor, you got say like 60,000 shares. But this round is a fairly smaller round. You're raising only like say what? At 60 rupees, you are raising only total of 10,000 shares. Okay. So in that, that is a total fundraise round. So it's not actually like justifiable for you as a founder to convert the entire 60,000 which you have given to 1 lakh shares and dilute or like give a major portion of the company to the previous investor. Because this is actually a small round, but you need this round to like survive for next 6 months and you're quite sure that your Series B is going to be much higher than the previous round. So in that case, this weighted average comes into play. So there they will be considering like kind of the previous round was for 60,000 shares. This round is for 10,000 shares. So there they like kind of take the weighted average and arrive at a value, weighted average value, and such number of shares are extra allotted to the investor. Okay. So this adjustment considers both price and volume of new shares. Considers price of new shares, number of new shares issued. More balanced approach for both parties. So this is actually a win-win for both founders and investors. Most VC deals use weighted average protection. So this is the standard one. Typically, I have also seen in most of the deal. Full ratchet typically like I haven't seen used in much of the deal. It's actually highly protective for investors, but very dilutive for founders. Okay. So again, you have to be careful when why this clause is important is because see at some point maybe like you'll have to go for a down round because you know that the market condition is not good. For example, currently there is a war going on between Iran, Israel, and US. It's actually affecting the entire world. It's affecting the people of, I mean, it's directly affecting us also with the LPG shortage and everything. So anything can happen in the business. And at this point of time, you are expecting that at least you need a runway of 6 months or 1 year for that, so that there is no point demanding a higher valuation at this stage. I'll come down a bit on the valuation and I'll raise some funds so that I can survive for the next 12 months. You may be doing this with a very good intention to protect I mean, to survive your business, to make or to provide result to everyone who is invested in the business. It can be the investor, it can be you, it can be your employees, whatever. You're doing it in a good decision. But if you have already signed a full ratchet anti-dilution clause with an investor, this decision will cost you like maybe you may lose extra 30% of the company just because of this decision. So that is where you have to be careful, like when agreeing such terms. Okay, I hope this is clear. Now again, like we'll discuss what is pro-rata rights or preemptive rights. So pro-rata rights allows investors to maintain their ownership percentage in future funding rounds by investing additional capital. Without this right, investor ownership would reduce due to dilution. So just remember the earlier example I told. It was 100% of your company. The first investor got 10%, you become 90%. When the next investor comes and they get 10%, you get diluted to 81. Previous investor get diluted to 9%. They lost 1%. So this pro-rata right or preemptive right is a right given to the investor to maintain their 10%. So if they want to maintain their 10%, they have a right to maintain 10% in the company. For that, what they should do is they should also subscribe to the additional shares issued in that round at that same valuation. So they will also have to bring in capital. It's not something like you are giving shares free of cost to the investors just to maintain their percentage. So that is not going to happen. So it typically gives a right to if you're a new investor, if there is a preemptive right and pro-rata right for the investor, you would ask them whether they are going to exercise that right. And only if they are not going to exercise, only you can raise funds from outside. Okay. And if they are exercising, they will also be a part of that particular deal. Because see that gives them the right to I would say what? It's a fair thing, right? So they own 10% of the company. They want to retain 10%, and you are raising funds for the company. They're okay to bring in another 1% worth amount. They're okay with that. So that right gives them the right to keep their percentage intact. Okay. So ensures investors can continue participating in the company's growth because they are quite sure that this company is going to grow. And I always want to own 10% of this company so that when you exit at 100 crore, I will get 10 crore. That would be the investors, this one. And maybe at this round, since they just want to adjust for the 1%, they'll have to invest only very minimal amount. Okay. So there is an example, investor owns 20% of the company raises a new round. With pro-rata rights, investors can invest additional capital to maintain the same 20% ownership. Without pro-rata rights, ownership gets diluted with each new funding round. So this is again an investor protection clause. But like very important for the founder also, because see, when you're raising funds from another third party or another new set of investor, you always have to check whether there is pro-rata right for the existing investors. If that right is there, you should be asking to them in writing, in email or whatever form you have agreed upon in the shareholders agreement, that whether they are exercising their preemptive rights. Okay, then only you should be raising funds from outside. Okay, now we'll come to founder vesting. Just a second. So vesting is a common terminology which you might have come across when you deal with ESOP. So see, founder vesting is something like even founders may be required to vest their shares over time. Okay. So this is where, for example, you own the capital structure of the company is 1 lakh. You have 1 lakh shares, and as a founder, you own 80,000 of the shares. The investor have 20,000 shares. If there is a founder vesting, the investor typically can do a founder vesting structure like this. I mean, this is not a mandatory structure. This is a typical structure. So it says 4-year vesting period, 1-year cliff, which means that in the first year, for some reason, if you are exiting the company, if you are resigning from the company, okay, that means that you will lose the entire 80,000 shares. You will have to forfeit those shares. You won't be able to hold 80% of the company with 4-year vesting period. And suppose like 25% of whatever shares you are holding gets vested each year. So if you exit in the first year, you get nothing. Okay. If you exit after the second year, you get 25% of 80,000, 20,000 would be there. If you exit after third year, you get 40,000. After fourth year, you get 60,000. After fifth year, you get 80,000. Why these clauses are agreed upon or kept in the agreement is that founder should also be committed to the business. Because see, typically investor is the one who is investing capital. And if you ask me who actually loses money in any deal, the main answer would be investor, because investor is the one who has put majority of the capital. So they want the founders also to be very serious about the business, and they want the founders to remain in the business. So for that, they may put a founder vesting. Okay, so even if you own 80% of the company, that doesn't mean that you ideally own the company. If you have to leave for some reason, you are not interested in doing this business, or for some reason you want to resign and go out, that means that you may give up all your shares. So you have to ensure whether founder vesting is there. Again, if you ask me, is this a fair clause? This can be a fair clause if you negotiate well and if you agree upon a mutual founder vesting schedule. The purpose is to ensure founders remain committed, prevents early exit with large ownership. Okay, so you own 80% of the company and you are planning to leave the company. So okay, that's not going to work. You won't get the 80,000 shares. Okay. Example: founders own 40% equity. If the founder leaves after 1 year, 25% of the shares vest, that is 10% of the company. Remaining shares return to the company. After 4 years, 100% of shares fully vest. This is the example what I told. I hope this is clear now. Now we have board rights. Okay. So again, I've given an example board structure: 2 founder directors, 1 investor director, 1 independent director. See, board rights means the investor. It's a right giving we give to the investor to be a part of the board. So in almost all deals, typically investor asks for a board right. So typically there will be 2 founders. So they ask for 1 seat in the board. It can be a directorship or it can be a board observer also. When I say observer, an observer is somebody who oversees the operations of the board. So you just need to consult with him before you take any decision. And you need to inform him before you are conducting any board meeting. So I mean, it's more like a director, but with no signing power or anything. So typically, investors would be asking for this. But here, what you need to be aware is that see, no case the investor should have majority control over the board rights, which means that eventually you are not going to control the company. The investor is going to control the company. So typical structure is 2 founders plus 1 investor director. See, independent director is not a mandatory thing. It's I mean, that if you become public company only, that's mandatory, but I've just given as a structure there. Board representation ensures investor oversight and governance. So this helps the investor to see like what is happening in the business, what is happening in the day-to-day operations of the company and everything. Then decisions requiring approval, so raising new funds, strategic partnership, hiring key executives, sale of the company. So for all these things, the board has the power, which means that the investors vote or like the investor will also be part of these discussions, or the investors person will be part of this discussion. So it always needed be the investor who come as a director or the board observer. It can be a person nominated by the investor also. Okay, so board rights is another thing which we typically see in any term sheet or like SHA. Then we have reserved matters. Reserved matters are matters which require the investor consent. So there will be a list of reserved matters entered in the term sheet or shareholders agreement, which without the permission of the investor, you cannot do it. And if you do such things, the investor can challenge you legally. Okay, so certain major decisions require investor approval. These are known as reserved matters or protective provisions. Purpose: to ensure investors are protected from decisions that could negatively impact their investment. So they need to see whether this is going to impact the investment what they have made into the company. So common examples for reserved matters are issuing new shares. So when you're issuing new shares, the investor will have a dilution. So they need to be informed. Raising debt. So at what rate of interest you are raising the debt, from whom you are raising the debt. So those things they need to know. So that could be a reserved matter. Changing business model. So you are pivoting the model. So you are running a fintech company. Now you are going to convert the company into a insurtech company. So changing the model. So that requires the investor approval. Then entering large contracts. Say any contract worth more than ₹1 crore should be entered only with the consent of investors. They can do that because those are substantial contracts and that can impact the long run of the business. Maybe entering into large contracts, and if a client back after a while, the entire business may get affected. So that's another matter which they can come up with. Then selling company assets, that's again another thing. Then mergers or acquisition. If you plan to merge or acquire any company, then that also comes under reserved matter. Even if it needn't be you acquiring or merging, it can be somebody coming to acquire you also. Okay, so these are a few common examples which we see in reserved matters. Typically, this would be a list of 10-15 items. So again, be aware of what you're signing. So for normal day-to-day business activities, typically people don't write that in reserved matters. So you should also ensure that those things are not mentioned in the reserved matters, because that is going to cause a lot of operational delay in the company. Then we have tag-along and drag-along rights. So tag-along rights protects the minority shareholders. So how it works? So majority shareholders decides to sell. So for example, the founders decide to sell. Minority investors can sell on same terms. Okay, prevents being left behind after control change. So typically, for example, there is a founder group and you are planning to exit. You got a good deal, so you are going to sell the shares, which means that if the tag along rights, the investor, if they exercise that, their shares will also have to be tagged along with your shares and sold to the potential buyer at what terms and conditions you have agreed up. So tag along rights is tagging their shares along with this one. So this is for minority shareholders to protect their interest and not to left behind after a majority stake sale happens. Then we have drag along rights, protects majority shareholders and investors. How it works? Okay, buyer wants 100% of the company. Minority cannot block the deal. Enables clean exits in acquisitions. So typically, there is an investor group who wants 10% of the company. There are other investor group who wants 25% of the company. 65% of the company is with you, and you got a potential buyer, good buyer. You and the 25% investor group agrees to this deal. You guys want to proceed, but that 10% people are against it. Okay, so if you have the drag along rights, what you can do is that you can drag these folks along with your shares and sell it off. I mean, they get 10% worth value, but typically it's a protective provision for investors not to block any deal. Okay. Then a real term sheet example. This is what I've told. I mean, this is not how a term sheet is going to look like. This is just like enough few deals which we have given. So deal terms, pre-money valuation 40 crore, investment 10 crore, post-money valuation 50 crore, which is pre-money valuation plus investment. So the investor ownership is going to be investment amount divided by post-money valuation, which is going to be 20%. The key clauses in the deal are liquidation preference, 1x non-participating, anti-dilution, weighted average, board structure, 2 founders plus 1 investor plus 1 independent director, then pro-rata rights, investor can maintain ownership in the future round. So what are the practical outcomes? Investor gets downside protection because there is anti-dilution. Founders maintain operational control because the board structure contains 2 founders plus 1 investor plus 1 independent director. Exit distribution remains balanced. Why? Because liquidation preference is there. 1x non-participating. Okay. Then founder checklist before signing, like I've told before. Before signing any term sheet, carefully review liquidation preference. Is it 1x or higher? Participating or non-participating? You have to check that. So if you have signed for a 5x LP and you realize that after like at the time of exit means there is nothing doing. I mean, see the investor invested 5 crore. They got 10% of the, or say, I mean, the investor invested say 2 crore. They got 10% of the company. And eventually you are selling the company for 25 crore. And there is like 10x of liquidation preference, which means that the investor will get 20 crore upfront and the remaining 5 crore distributed revenues too. So those things should not be there. So be aware of what you have committed, what sort of liquidation preference is there. 1x is very fair, 1x is very standard. I mean, 1x you should be agreeing because without that, I don't think any investor would be coming in because they also need to protect their capital. Anything above 1x, yeah, depends on the stage in which you are raising the fund. Typically, I haven't seen that much, but if you are raising in a desperate stage and you want this capital, it's okay to go for 1.5x or 2x. But anything above 2x, I mean, whatever desperate you are, I wouldn't recommend going. Okay. Then participating or non-participating, that again you have to check. Then regarding anti-dilution protection, is it full ratio or weighted average? So if it's full ratio, if you're raising a down round just for a short runway, means that you can give up 30%, 40% of your company because there was a down round protection or anti-dilution protection for the investor. So and always ensure that it's weighted average. Then full ratio can cause severe founder dilution. Then board control. Who controls the board? So typically it should be founders who have the majority control in the board. This ensures founders retain reasonable influence in the company. So that's something what we have already discussed just a while ago. Then resolved matters, which decisions require investor approval, understand operational implications. That's what I've told. For petty matters like any transaction above 10,000 rupees requires investor approval means that you're going to have serious trouble running the business. Because for every petty things you have to go and seek investor approval. So that's not going to work. So make sure that whatever you are approving is or whatever you're giving to the investor is well within or that are matters which is very important and critical. Okay. And not of a daily routine kind of thing. Then founder vesting, understand vesting timelines, no exit implications and cliff periods. So if there is a founder vesting which the investor is asking for you, which they can ask, which again I see to be very fair. Understand what is the vesting timeline. See, the vesting timeline cannot be 10 years, 15 years and all. It should be something 3-4 years kind of thing. And what if also understand what if you exit within 2 years? So you may not be having an idea of exiting the company in 2 years. But what if you have to exit? So always think about such scenarios also. Because an agreement, see, when does an agreement come into picture is when things turn bad. If everything is going good, there is no problem with anyone, everybody is happy. And what people typically do when they sign an agreement or then they commit to some sort of clauses is that they think everything in good faith and in a good situation. What I would recommend you is that always imagine what the bad situation is going to be. If I have to exit the company in 2 years, if I have to if I have to maybe raise the funds at a down round. See, typically people don't expect to raise funds at a down round. Everybody is positive, everybody is ambitious about their business, everybody is confident about their business, and they always expect that now I am raising at 10 crore, next valuation is going to be 50 crore. But what if you have to raise at 8 crore? What are you going to commit? So always be aware of such things. Think it from both angles. Think about the negative side, think about the positive side. So if at all the negative side happens, make sure that you are also safe in that scenario. Okay. So key takeaways when reviewing a term sheet, like just understand that valuation attracts attention. So you get all the PR, you get all the limelight thing. You eventually believe that you made a big business and everything, but closest determine outcomes. So even if you get 100 crore valuation, but there is a founder vesting for 15 years. I mean, there is no point in getting 100 crore valuation then. So closest determine outcomes. So valuation attracts attention. You get a lot of PR. You stay in the limelight. You feel mentally like kind of you are the owner of a 100 crore company. But what if the clauses doesn't give you that ownership? So clauses determine outcomes. Understanding these clauses is critical before signing. Okay, a well-structured term sheet balances founder control. There should be founder control. There should be investor protection. There should be fundraising flexibility. You should be able to raise funds in the future also. There should be exit opportunities. So these 4 things should be there in any sort of term sheet or shareholders agreement or whatever you are signing. Okay. Yes, so that's it from my end. I've kept the QR code to connect with me on LinkedIn and to join our WhatsApp group for the next session. Now I'll take your questions. Over to you guys. If anyone have any question, you can unmute yourself and come up with a question. Yeah, Prateek.
Yeah, hi Abhijith. I mean, thanks a lot. This was indeed a very insightful, overview.
Okay.
Especially for first-time founders like me, right? So I had this question. I mean, most of the things that you covered is mostly like the P or VC dilution, right?
I mean, see, I've seen these sort of agreements for angel networks also. It's
Yeah.
not just like kind of P or VC kind of. I mean, I cannot say that it's specifically related to P or VC. These sort of flows happen at every stage.
Right. So we are now, I mean, looking at an investment without dilution. That is, they are just doing like a 2x return for
Okay.
long-term 7 to 8 years kind of investment, and it's a high cap investment for a global thing. So in that sense, I mean, I don't know what exactly should be, the kind of term sheet that we need to look into, or like, can you shed some like light on it? Maybe I'll also get in touch with you later on. Yeah, thanks.
I mean, see, if you're looking for something sort of that, see, primarily, like you have to find an investor who is going to come in at the terms what you actually want. Okay, so that's very difficult to find primarily. So primarily, like it's typically like you know what money you want. You have an idea in your mind, like how you're going to repay the investor or what is the kind of thing that you're going to do with the investor. You approach the investor, they may be having their own view. It's always better to be flexible with these things. Once they come up with their terms, then it's better to negotiate and reach a middle ground or something. And I mean, these clauses can come, may not come. There are big deals happening between HNIs and other companies where these sort of agreements may not be there. Then there are convertible instruments coming. So there are a lot of plug and play options for any founder to have that sort of flexibility and all those things what you actually want. So I mean, so it's actually a bit difficult for me to answer your question rightly, but I think what you might have understood what I meant.
Right. Yeah. Absolutely. Yeah. Fine. I'll try to get in touch with you at a later stage.
Yeah. Sure. Yeah. So, Kalayarasi Nano.
Yeah. Hi. Hi, Abhijith.
Hi.
So I just want to know whether is it okay or possible that the share transfers between the founders after the investor comes in?
I mean, see, again, depends on the the shareholders agreement that you have signed. Okay, so typically in the shareholders agreement and this term sheet, there would be a clause restricting the free transferability. So primarily, like kind of, you have to offer it to the existing shareholders, and you will have to take consent from the investors. So if you ask me if the founder transfer amongst the founders is possible, again I'll have to check your SHA. But typically, like kind of, it is possible, but the investor cannot restrict such things ideally, unless and until they put some sort of transfer restrictions. But if you want to transfer, what you can do is just read your SHA or term sheet, whatever you have committed, get a confirmation from all the investors stating that they do not have any objection in the transfer. So that again specifically depends on a shareholders agreement. So recently I had such a scenario with one of my clients wherein I've gone through the SHA. They haven't explicitly stated that there should be a written agreement or anything. So we got mail confirmation from all the investors that they do not have any objection to transfer. And we proceeded with the share transfer.
Okay, thank you. But I just want to know one more, whether it is mandatory to get no objection from the investors for whatever the agreements that we have with the founders or shareholders.
I mean, see, typically it should be transparent is what I believe. See, because these are things which affects the capital structure of the company. These are things which is going to affect the investors also. So typically, if you don't have a term sheet or shareholders agreement in place, then these questions are not. These questions does not have a validity. But if the investor has taken equity shares in your company, and there are matters which you actually can decide only in a general meeting, which is the meeting of the shareholders, obviously you'll have to give 21 days of notice to the investor also to join such meetings. Then only you can take decisions there. So typically, like, there is a general protection which the Companies Act provides to every shareholders, and there are special rights or special protection which you typically come into in a shareholders agreement or a term sheet. So you have to be aware of such things.
Okay, thank you so much.
Yeah. Anyone else? I mean, if you don't have any more questions, we'll wind up the session. So yeah, thank you guys. So see you again after a couple of weeks, like every Fridays. I mean, every alternate Fridays we have the session. So the next session is supposed to be on 27th March, Friday.
Abhijit,
So
is it okay if
yeah.
So the question for me is, like, if I'm going to a venture studio, right?
Mm-hmm.
In that scenario, is it exactly the same as like the term sheets, the stuff that you mentioned? Is it the same? And also, if I'm actually going with, like, say, racing with friends and family, should I then also get something similar to term sheets with them? Is that the situation?
I mean, for friends and family, I wouldn't recommend you to have a term sheet or an agreement. So, but it's better to have a simple agreement. I'm sorry for using that word. So it's I would not recommend is a wrong word, but it's better to have a simple agreement or some sort of clarity amongst you, like on what terms they are investing. Because see, tomorrow if they come and say that they have given to you as a loan, but you have considered it as an equity, so that can be a problem. So just have such clarity, basic clarity you should be having. But if you ask me, like, you need to have a full-fledged term sheet or a shareholders agreement, I wouldn't recommend you to have such things. Okay, and venture studio, the question, like, again, depends on the venture studio that you're working with. But typically, venture studio have certain clauses which we typically won't have in a term sheet. Maybe like they may charge you success fee on every fundraising that you are going to do in the future. Not just the fundraising that they help you secure, but for every future fundraising. So those things would be there. And venture studios typically charge some sort of fees and some sort of amount from you for the kind of services that you are availing from them. So there could be clauses like that also. So that typically depends on the venture studio that you're working with.
Awesome, thank you. That was helpful.
Thank you, Dinesh. Yeah. So guys, I'll wind up the session now. So it's 7:25. So we'll have the next session on 27th of March. We'll update you about the topic. If you join our WhatsApp group, you can get to know about all the topics and everything. And you can connect with me on LinkedIn if required. Okay. So thank you guys. Bye. Have a good night.
Thanks a lot, Abhijit.